So you and I, we love wholesaling,
Mm-hmm.
right? Giving us a lot.
Mm-hmm.
What's going to happen to wholesaling, you think, in the next 5 to 10 years?
Yes. So I've been thinking a lot about that because I'm always, my career has been in wholesaling, building a business, and then teaching, right? Wholesaling. So, in looking at of what's going on in the regulation side of the market is interesting, meaning we have to play cleaner than we ever had before. And we were kind of living in the wild, wild west.
Well, we were in unknown territory for the longest time.
Yeah. Like this wild, wild west back in, we were in a small little niche that nobody really knew about. We didn't really disrupt the real estate industry. I mean, the realtor industry, because there wasn't a lot of us.
Mm-hmm.
Now there is a lot of us because of you and I, right? And other people out there now that, influencers are talking about, this niche. So now, there's laws that have come out in certain things in like Oklahoma and Illinois and Philadelphia and Georgia and stuff like that. So you're just going to be a little bit careful in what you do. Now, could that law propagate to federal? Possibly. Could it go state by state, where each state by state just starts, releasing things? Yes, but it will be a harder game to play, a game that still can be played, but you will have to close on your deal. You'll have to be the buyer. You'll have to close on your deal, and you have to be able to get it done. Now, interesting, the novations / RBP model, where you're getting paid off the HUD on a recorded, essentially a lien release.
Mm-hmm.
That I haven't seen anything about. So that could be a surviving methodology that could happen. If anyone's not doing it, I'd highly recommend looking into doing that type of model. But the bottom line is that either A, you close on it, right? And you're the buyer, you close on it,
mm-hmm.
and then you just stick it on the MLS and sell it. There's nothing wrong with that. You can do that all day long, twice on Sunday, within the certain, marketing laws in Georgia and, and stuff like that. But if you're the buyer and you're going to offer someone cash and you can close on it, it's your deal and stuff like that. You don't have to, you don't have to market a property you don't own. You don't have to, stuff like that.
Mm-hmm.
Then, you'll be fine. So what are two ways that could that you can continue to operate or prepare for? One is either A, be well capitalized, or B, two, have a lender that you can work with to close and resell,
mm-hmm.
right? And have a lender in your pocket that could start doing those deals. Or two, be able to really understand the Novation RBP model where you can start doing those. Those two things, I think you become essentially resilient, even if Novations and RBP goes away
mm-hmm.
at some point, than doing just the buy and sell type of thing.
Yeah.
There's no reason why you just can't buy it or sell it.
Yeah.
What do you think about that?
So you look at, the number one lobbying firm, right? For the longest time, I haven't checked recently, the number one lobbying firm, the NRA, National Rifle Association,
Yep.
right? Second Amendment, all about the Second Amendment, right?
Yep.
That's number one. Number two is the National Association of Realtors,
Right.
right?
Yeah.
That's the second largest lobbying arm in the country, right? And I'm a licensed realtor, so every year they just take out $35 out of my dues, goes right into the lobby.
Wow.
And there's 1 million plus realtors.
Wow.
That's $35 million every single year going to the coffers of the National Association of Realtors.
Yep. They
Right.
can just start paying off politicians to get their ways on certain
They're
things.
very well funded, right?
Yep.
And so what you're talking about with Oklahoma, I'm not sure exactly what drove it in Oklahoma. Illinois, you had to be licensed. Philadelphia was driven by one of the most successful realtors in Philadelphia. Shocker.
Yeah.
Right.
Yeah, exactly.
And so there's this thing that's happening. And when I started this podcast over 5 years ago, I started the first 10 episodes. It was wholesale, realtor, right? Because I believe that there's no reason why wholesalers should dislike realtors and realtors should dislike wholesalers.
Yeah.
There's no reason for it.
Yeah.
But it exists,
It
right?
does, yeah.
And so I believe that in 5 years, if you haven't figured out how to close on every single deal, you're going to be in trouble, right? And you don't need 5 years. You can figure this out in 5 months. You can figure this out in 2 months.
Yeah.
Right? Go get funding.
Yeah.
Go create a relationship with someone who's got money.
Right.
Right? We already know how to find motivated homeowners. It's not that hard to find people with money.
Right.
So,
well, the interesting thing is, think about this though. Think of the opportunity. Yeah, I mean, but think about the opportunity. So what if you were a forward thinker and you built those relationships today, and something does come on down the line, literally all the wholesalers would be gone, and there'd be a handful of standing that would get all the deals, because that market's not going away.
Right.
Distressed properties is not going away.
Yeah.
And you still can do your Google AdWords, but your cost per lead's not $85, it's $18 or it's 18 cents. You know what I mean? It's like, and now your profit margins, and now instead of a leads per deal at 31, I mean, average deal size. So you're having an average deal size of 50, 60 grand because you're buying on it, closing on it, getting the best deal and selling it.
Yeah.
You might have a capital cost in there, but still
there'd be less competition.
Less competition.
Right. So really, and this is the thing that I've always said about regulation, like if it happens, who wins? Not the homeowner, right?
Yeah.
Because they're going to get offered less because there's less competition.
There's less competition.
And we have to buy it deeper for the numbers to work.
Right.
Homeowner's not the one who's going to win.
Yeah, because they still have to sell.
Right.
They still need to sell.
Yeah.
Right. It's not that they want to sell. You know what I mean? I'm just going to listen. They're in a situation, they have an impending event, and they have to sell.
Right. And so with regulation in place, there's less competition. Our cost per deal goes up, capitalization costs. So it's coming out of someone's pocket.
Right.
And it's the homeowner.
Yeah.
Yeah.
So The Big Short,
Mm-hmm.
Michael Burry, you see what he just did?
He shorted the S&P.
Yeah.
He took like 85%, or he took some stupid.
92% of his portfolio. Now he did it with derivatives. He did it with he bought puts and calls. Now, puts and calls, you can put less down and control more.
Mm-hmm.
So it could have been the way he structured it a little bit different. But that being said, it's still $1.6 billion position, essentially, they're controlling, betting the market's going down, right? I mean, that's a big position. He got clobbered yesterday because the market went up 5 points. He probably just took a massive hit, but he doesn't care, right? So here's my question to you: is he in Big Short basically had this big monster play, and he had a conviction that the housing market was going to crash, right? And his play was to bought insurance swaps on default debt or whatever. So Bill Ackman, you know who Bill Ackman is? He's a hedge fund guy,
yeah,
stuff like that. So he had a big play in February of 2009, and he essentially bought puts on the S&P 500 to the tune of $26 million and turned it into 2.6 billion. Crushed it, right? Because he knew something. He heard the thing that was coming out that was going to crash the market, and it did. So here's my question to you. That being said, we know something's coming. What's the big play?
What's the big play?
And I ask everybody.
What's the big play right now?
The big play. What's the big play? What is your big play? What's your Bill Ackman? What's your Michael Burry play?
Oh, I mean, the problem with options is they still cost money.
Yeah.
Right? There might be leverage, but you still have to put a significant amount, and that option reduces time. It's not a permanent option.
Yeah. Like an ice cube.
Yeah. So I know something's going to happen, but I don't know when it's going to happen.
Right.
That's the problem.
Yep.
Right. If we could time it, it'd be great.
Right.
I'm fully confident the market's going to go down. The stock market's going to go down. Real estate, I don't know. It just doesn't make sense. If you talk to me, like all of us in 2020, right? In 2020, when COVID happened, right? I call it the toilet paper crisis of 2020, right?
Yep.
When that happened, I was ecstatic, right? Because I was like, okay, I survived 2009. I know what this looks like. I've got money ready to go.
Yeah, let's go.
I've got relationships. I got money in the bank, right? I know how to source properties. Let's freaking go. It did not crash.
Yeah, it went straight up.
It went straight up.
Yeah, because all the foreclosures, they just kicked the can down the road, right?
Yeah, all the forbearances and this and that.
I thought the exact same thing.
So if I were to bet it all then, I would have gotten crushed.
Well, actually, you probably would have done well because the market did go up 2020, 2021 to later 2022.
But I'm saying like where I was going to start acquiring assets from my portfolio.
Yeah.
Right.
Yeah, you would have had to buy and then sell within a year to 2 years. And then,
Yeah, right. So I'm looking, because I was looking forward to like 20-30% price corrections and
Yeah.
buy and keep, right?
Yeah.
Just buy and hold.
Stick in there.
Yeah. So right now, I mean, I know the stock market's going to go down. I know there's going to be a lot of pain because you can't keep raising the Fed rate like this and have no pain. It just doesn't make sense.
Yeah, that's what I'm saying. It's per historically, it's job market is 15 to 18 months before you start seeing basically a loss in jobs.
But like every report says like, okay, we're expecting this much job loss. Oh, we did not lose that many jobs. Okay, this month for sure we're going to have this much job loss. It came out
this morning.
Yeah.
It did go down, but the market went up.
Yeah.
See, isn't it bad news? In the market, the stock market goes up, but there was negative today.
Yeah.
But not a lot, little. You know what I mean? Even GDP went down today.
Yeah. So something's got to give. The problem is with options and shorts and this and that is there's a window.
Right.
And I don't know when it's going to happen. I just know it's going to happen. So I guess if the big play, if there was going to be a big play, is to put, 10% of your cash shorting the market. But you can't short sell the market because you still have to, it's a long-term play, right? Or it expires. You can't do a long-term short.
Yeah, so Michael Burry, basically, he bought puts on the QQQs, which is NASDAQ, and the SPY, which is 500. But he did what's called leaps, right? So leaps are long-term equity positions, right? So a leap is something that's a year out, right? So the time decay doesn't happen. It happens over a year time frame. So if nothing happens in a year,
he's in trouble.
He can do it, but he also can sell options against his position and collect premium if it doesn't happen. So there's a lot of cool things you can do with options, and I like trading. Trading's fun, and I do it with just risk capital, whatever. And
so the longest I can short is a year.
Oh no, you can do long. You can I can buy a put option on the SPY right now, like 2 or 3 years out.
Okay,
right, and just hold on to it and just go through the fluctuations.
Yeah, I would say 18 months. I would say if I was going to do 18 months, it'd be if I was going to go hard, it'd be putting money in that we're gonna crash.
Yeah, but would you put 92% of your portfolio?
No, I would never put 92% in any. I love real estate.
He did that. He did that in Michael Burry did it in 2000, prior to 2008. Would you put 26 million like Bill Ackman did right before like the COVID crash? So it's got to be a convicted position, and it can't be a tester position, right? So, and I'm not talking about the stock market. I'm talking about more about real estate. But with I've been thinking a lot about the big play because there is going to be a big play that's happening. Otherwise, Warren Buffett wouldn't be sitting on his largest cash position ever in history. Why would he be doing that?
He could just be waiting for a correction to come in.
Right, I know. So he's waiting for the black swan. He's waiting for something to potentially happen. So I think we have to be patient. And it's hard to be patient when you flip on social media.
Especially
and
when
you
you're a
say,
driver personality.
I'm doing this and buying that and doing this.
It's
and
nothing
doing
to
that.
talk about. Hey, it's Monday and I'm still doing nothing.
Yeah, I'm still doing nothing, right? It's crazy, but it's but here's the thing I look at. If I'm wrong, that's okay. Then I just buy then.
Right.
You know what I mean? If I'm wrong and I load up on a bunch of property and real estate and go do, pull out some debt on some Class C apartment complexes, capital for and do all that stuff, and I'm wrong, I'm killed. You know what I mean? So, and all the investors with me are killed. I've been there, done that. I was wrong on land in 2008, and I went all in on land, right? At the wrong time, right at 2008. So, I look at it now where I'm like, it's okay to be patient, but look at what the big play, what is the big play that can be? And I do think, and it has increased 22% year over year, foreclosures, and I that's where I got started in foreclosures. I believe that could be a big play. A big play meaning where, for guys that are, doing houses and are used to doing house and stuff, that they still will have 2 to 3% mortgages. And if you get them before they hit the market and become inventory on the market, you can get a loan for 2 to 3%. You can give them $3,000 or $4,000, $5,000 to leave. You can, reinstate their loan for whatever, $10,000, $15,000, $20,000. And now you have a house that you can do, and you can turn around and lease option it, for a long term, and you can get cash flow. Now, here's the thing: is that you can do that where you get money. Literally, you can do it for break even, because if you lease with an option to purchase, you can get down payment up front. You can offset some of your cost up front. It doesn't take a lot of capital to build a large portfolio. I did it.
You did it. Yeah.
I did it when you don't have a huge, because you're circulating, and then you can sell property and you get a chunk, and you can take that and you can literally build $120, $30 million portfolio of properties. And here's the thing: is that I looked back historically of when the pivot happened in the real estate market, where inventory decreased, right? And if you look back when the market kind of comes back, you know when that time is? Have you ever looked at the chart?
I've looked at the chart.
And then kind of overlay it with quantitative easing or quantitative tightening. So you overlay the real estate market with quantitative easing. You overlay the stock market with quantitative easing. Well, quantitative easing is when the Fed comes in and pumps money in the market, right? Yeah. And if you pump money in the market, all asset classes rise. Gold, stocks, currencies, everything rises.
There's just too much money out there.
You pump money in the market. So right now they're quantitative tightening. If you look at the Fed balance sheet, they're basically trimming their balance sheet right now.
They're sucking the cash out of the market.
They're sucking the cash out of the market. So we're seeing stocks that are kind of hovering right there. But I mean, not stocks, but you see real estate kind of hovering right there. But it's going to have to correct. It's going to have to get in line at some point, and it could happen when these foreclosures happen. But I think there's a big opportunity. What if you built 50 houses, 100 houses, of doing that same thing, where you could do it with limited capital and build a huge portfolio? At the time when the Fed pivots, they start the quantitative easing, essentially the bottom. If you look at housing starts and housing permits pulled, guess when that number started to tick up? Quantitative easing, right? So think about, if that's the bottom and that's our signal, because you have to wait a signal before you get in. You wait for the signal, and who knows when that could be. They could start, they'll quantitative ease when there's blood in the streets, right? And they'll go, oh my gosh, we got to come in, we got to save everybody in quantitative ease. So when they do that, then we can turn around and I think and start buying some really smoking deals and build a portfolio and then ride that. And here's the thing: most people that are probably watching this, maybe or maybe not, but got involved in real estate after post crash. Right. Oh yeah. Most of the people I've talked to, I was in a room and I think there's a couple hundred people there, and I asked a question: how many people got in real estate post crash, like after 2008? 99% of the room. There was one guy in the entire room of like 200 people that raised his hand. I mean, so the thing to learn from it is that, in my opinion, my humble opinion, I'm not a prognosticator or whatever, but do your own research. Look at when the Fed pivots, quantitative ease. Look at what happens to the marketplace. Look at what happens to inventory. Look at what happens to all those technical indicators that we can look at and see what happens to that. And imagine if you bought 10, 15, 20, 100 houses then, right? You can ride it up as the inventory decreases, prices increases. Quantitative easing, they do lower interest rates. You either can refinance them out at lower rates, still cash flow, but you do have low debt on it because you took over the loan, or you can sell them into strength and you buy into weakness, right? You buy when everybody's fearful and you sell when everybody's at the height of the market. Yeah. So in 2021, that's when you sell, right? Because everyone's euphoric and they want to sell. So and here's the other interesting fact: if you look historically of properties being sold, if the 2005 properties being sold on the market, there was 7 million. 2021, guess what the number was? 7 million, right? Same, right? So that's the high is 7 million, right? Average is about 6 million. Guess what the low is? So 2008, how many houses do you think sold in 2008? If 7 is the high, average is, close, really close, good. 4.14 million. 4.14 million houses sold, and the worst housing crash that you and I know.
Right.
So you know what that tells us? Us as wholesalers, we have people, especially for selling to retail buyers, we can sell. Guess what's the difference between 4 million, 6 million, and 7 million? What that difference is? Cash buyers.
Yeah. Well, and I was a realtor at this time.
Yeah.
Right. And so I would show houses and there'd be lines out the door for the houses. And people would be like, why are there so many people looking to buy this house? This is a housing crash.
Yeah.
Why are so many people looking to buy? It's like, well, if you have a good house priced right, it sells.
Right.
If you like what you just saw, click this video next to me to watch the full episode.